In May 2026, pulling cash out of an ATM came with a sudden, sinking realization. The physical notes you held in your hand were losing their ability to buy the things you needed, almost by the hour. The purchasing power of the Indian rupee was plummeting, and financial institutions worldwide were watching the decline in real time. This collapse specifically measures the rupee's value against the global reserve standard, the US dollar. Everyday consumers were watching global market forces actively hollow out their personal savings, day by day. This chart tracks the exchange rate during the May 2026 shock. The rupee drops rapidly, breaching a historic threshold, 96 to $1. This tripwire signals global trading algorithms to automatically sell off Indian assets. This sudden wave of selling threatens to drain foreign confidence in the Indian economy. Investors rush to pull their capital out before the floor drops. A currency in freefall rarely finds its own balance. To stop the collapse, an institutional counterforce must step in and forcefully hit the brakes. That responsibility falls to the Reserve Bank of India, the central bank that controls the nation's money supply. Central banks try to let markets resolve themselves. An intervention, where a central bank steps in to manually manipulate currency prices, is a severe emergency measure reserved for when systems are actively breaking down. To defend the currency, the RBI has to consider its most powerful, blunt instrument, raising interest rates. By artificially making money more expensive to borrow, the central bank attempts to pull a massive macroeconomic lever to force the market to reverse course. Raising interest rates means Indian financial assets suddenly yield much higher returns. Foreign investors chase those yields, creating an engineered wave of rupee demand. This sudden surge acts as a floor, stopping the currency from sliding past 96 and forcing its value back up. On a spreadsheet, the mathematical theory is flawless. The international ledger balances out perfectly. But this mechanism operates entirely blind to what it costs the people actually living inside the economy. When the RBI turns that dial to attract global investors, it simultaneously drives up the cost of borrowing for every citizen in the country. Floating rate loans reset immediately. The monthly EMIs, the equated monthly installments you pay on your home or your vehicle, shoot up, instantly swallowing a larger percentage of your paycheck. Local businesses get choked off from operating capital. When loans become too expensive to service, small companies abandon expansion plans, cut back on orders, and freeze hiring. To make matters worse, a weak rupee means importing goods like crude oil costs the country more. That price gets passed down directly to the fuel pump, driving up the cost of basic logistics and transportation. The RBI strategy to stabilize the macroeconomy relies on actively draining disposable cash out of the domestic microeconomy. The physical bills sitting in your wallet represent a massive, unavoidable tension. The central bank faces an unforgiving choice: let the currency burn on global markets and watch inflation import itself, or step in and actively suppress domestic spending to save it. The 96 rupee crisis in May 2026 is a grueling test of national economic endurance, far beyond any simple statistical milestone. In the ruthless battle to defend a currency standing on the global stage, the heaviest toll is always paid by the everyday citizen at home.